In 2021, Bill Hwang's hedge fund, Archegos Capital, lost $20 billion in just 2 days. What happened? It wasn't a market crash. It wasn't a bad stock pick either. The culprit was over-leverage, borrowing way too much money to take huge positions. The trades you currently hold, that is actual capital, the cash you're investing with couldn't support. Picture watching your net worth collapse, all because you bet too big on too few things. What's interesting? What exactly went wrong here? And how do you avoid making the same mistake yourself? Why would someone stack blocks way taller than they can handle? Imagine trying to build a tower with blocks, but you keep stacking them higher and higher without thinking about balance. At first, it seems fun and exciting. Each block is like a new opportunity, a chance to reach new heights. But as the tower grows, it becomes wobbly. You start to notice the base isn't strong enough to support the weight above. Before you know it, the entire structure collapses in a spectacular crash. In the world of trading, this is what over-leverage looks like. Leverage means borrowing money to make bigger trades than your own cash can support. It sounds like a shortcut to big gains, but it can quickly turn into a disaster if the market moves against you. When you take on too much leverage, you're stacking up risk, just like those unsteady blocks. Think about this. You have $1,000. You decide to take a position, a trade you currently hold, by borrowing $9,000 more to buy $10,000 worth of stock. This means you're 10 times leveraged. If the stock price goes up, your gains are magnified. But if it goes down, your losses are also multiplied. And here's the kicker. If the stock drops just a small amount, say 10%, you've lost your entire capital, the cash you're investing with, and more on top of that. This is why traders need to be careful with leverage. It's like building a tower, exciting when it works, but devastating when it falls. And it falls fast when there are too many blocks and not enough support. So what's the lesson here? Understand your true exposure. How much of your account is at risk on a trade before adding more blocks to your tower? Because in trading, a strong foundation matters more than reaching the sky. Why is it that when you hear about traders losing everything, leverage is often involved? Leverage means borrowing to trade bigger than your actual account size. It can amplify your gains, but it magnifies your losses just as easily. Imagine you have $10,000. You borrow $90,000 to take a $100,000 position, a trade you currently hold. If the position moves in your favor, your profits can be huge. But if it moves against you even slightly, you could lose more than your original capital, your trading or investing money. Now let's talk about exposure. How much of your account is at risk on a trade? If you leverage too much, your exposure can be dangerously high. Picture a scale, one side labeled risk, the other reward. As you add more leverage to chase bigger rewards, the risk side starts tipping. At some point, it becomes too heavy, and the whole thing collapses. To avoid this leverage trap, start by understanding your true exposure. Ask yourself, how much of my account am I willing to risk on this trade? If the potential loss is more than you can handle, it's time to rethink. Adjust your position size, the amount of money you put into a single trade, to match your risk tolerance. A smaller position size can often save you from catastrophic losses. Think of it like driving. You wouldn't accelerate full throttle if you're unsure about the road ahead. Similarly, in trading, you should approach new positions cautiously. Balance your ambition with the reality of market movements. The goal is to keep the scale balanced. It's not about avoiding risk entirely, but managing it wisely. Ensure that your potential rewards justify the risks you're taking. In the world of trading, patience and prudence can prevent a fast fall. And that's something every successful trader understands. So next time you're tempted to use high leverage, remember, keep your scale in check. The rewards can wait, but your account might not survive if you don't. Picture yourself at a poker table with two paths in front of you. On one side, a single towering stack of chips, all your bets on one hand. On the other side, your chips spread across several hands. Which path would you choose? In trading, this mirrors the choice between concentration and diversification. Concentration means putting a lot of your capital, your money you're willing to invest or trade, into just a few positions, the trades you currently hold. It's like betting all your chips on one hand, hoping for a big win. The problem? If that hand loses, you walk away with nothing. Diversification means spreading your capital across multiple positions. It's like playing several hands at once, each with a smaller bet. You might not win as big on any single hand, but if one goes south, your overall stack stays safe. The pull of concentration is strong, just like the dream of winning big on one lucky hand in poker. But here's the thing, concentrated bets can lead to disastrous outcomes, especially when combined with leverage, borrowing money to trade bigger than your account size. Leverage amplifies both gains and losses. One wrong move on a concentrated bet can wipe out your portfolio faster than you can react. Imagine all your money tied up in one stock. Suddenly, bad news hits, the stock plummets, Because you're heavily leveraged, your losses pile up even faster. This is the risk Bill Hwang faced. By concentrating his bets and using leverage, he set himself up for a potential massive gain or a catastrophic crash. So which path should you take? The diversified one. By spreading your bets, you reduce the risk of any single event wiping you out. It's not just about avoiding catastrophe. It's about steadily growing your wealth over time. As we move forward, think about how you can apply this mindset to your own trading. The next segment will get into a real-world example of what happens when the scales tip too far toward concentration and the dramatic fall that follows. It's the same edge a poker player has at the table, the discipline to fold a tempting hand when the numbers turn, and the nerve not to tilt after one bad beat. Picture this. You're watching TV when suddenly a news flash reports one of the largest financial collapses in recent memory. The name blazoned across the screen is Archegos Capital Management, a family office led by Bill Hwang. In just 2 days, they went from managing over $20 billion to virtually nothing. How does something like this happen? At its core, the Archegos collapse was a dramatic example of what happens when you mix over-leverage and concentration without proper position sizing. Let's break that down. Leverage means borrowing money to increase your buying power. In trading, it's like using borrowed funds to make a trade bigger than your own capital, your trading or investing money would allow. But leverage is a double-edged sword. It can amplify gains, but it can also magnify losses dramatically. Archegos made concentrated bets on a few select stocks, piling into positions, trades you currently hold with borrowed money. This concentration is risky because it puts all of your eggs in a few baskets. If one or two of those stocks perform poorly, the losses can quickly escalate. Without adequate position sizing, determining how much money to put into a trade, a small drop in those stocks' prices led to massive losses. Imagine you're sitting at a poker table and you decide to go all in on a single hand. If the cards don't fall in your favor, you're out. That's essentially what happened at Archegos. When the stocks Archegos bet on began to decline, the firm's leverage worked against them, and they couldn't meet the margin calls, demands from brokers for more funds to back their positions. This forced them to sell their assets at a steep loss, triggering a downward spiral that wiped them out. The lesson is clear. Decide your position size before entering any trade. It's about knowing how much of your capital you're willing to risk without jeopardizing your entire account. In trading, just like in poker, the key to staying in the game is managing your risk. The Archegos story is a textbook case on why the discipline of position sizing matters. But here's where it gets interesting. What specific steps can traders take to avoid this fate? You've heard that you should decide your position size before entering a trade, but how do you actually do that? Let's break down the position sizing first rule. Start by deciding your stop loss, the price where you exit if the trade goes wrong. Without this, you're sailing without an anchor. Once that's set, calculate your position size. Take 1% of your capital, divide it by the distance to your stop loss. This way, even if the trade busts, you only risk a tiny slice of your account. What's interesting, the power of this rule is its simplicity. By putting risk management ahead of potential gains, you make sure no single trade can wipe you out. It's what separates disciplined traders from people gambling on hope. If this is clicking for you, consider subscribing. We cover insights like this twice a week. Using this rule could be the difference between a small setback and a catastrophic loss. It's about staying in the game long enough to see another day. So next time a trade looks promising, ask yourself, have I sized my position wisely? Found this useful? Hit subscribe. We share trading psychology tips that make tricky ideas simple. Stay informed, stay prepared, and stay in the game. Click subscribe now so the next tip reaches you before the next trade tempts you. The pattern is clear. This isn't just about making money. It's about protecting your capital, the money in your trading account, from the traps of over-leverage, borrowing to take bigger trades than you can actually afford,